What happens to interest rates when inflation increases? Does it go up or does it go down? The banking authority of a country will determine interest rates and use them to help manage inflation rates worldwide. Higher interest rates incentivize people to save, while lower interest rates incentivize spending. In today's video, we will break down the bank's role in inflation and the impact interest rates have on spending. Firstly, let us define how inflation is recorded. In simple terms, the price of something today relative to tomorrow will tell us the inflation rate. If a liter of milk costs $1 today and tomorrow costs $1.05, the rate of inflation would be 5% because the price increased by 5%. This is how inflation is measured. However, it is done with a variety of goods consistently measured regularly by a governing body within a specific country. This variety of goods is known as a fixed basket of goods, and the overall measurement of this basket is known as the CPI, or the Consumer Price Index. Inflation is, therefore, the rate at which this fixed basket of goods increases in price. The inflation rate is vital to the economy as when it fluctuates too much, consumers and business owners find it difficult to spend and price goods and services accordingly. Where does the interest come in then? Interest is charged on the amount one borrows or is earned on what one saves. Financial institutions that offer to protect and borrow services, such as banks, will provide interest rates as a part of their business model. If you have a total of $1,000 in a savings account and the bank you are with offers a 2% interest rate per annum, you will earn a total of $20 as an incentive or a payment for storing your money with them. 2% of $1,000 is $20, and so a 2% interest rate garners you $20 of interest. If it were 4%, you would garner $40. Banks offer incentives for saving because a bank will use your money to lend to someone else. Now, if you were to instead borrow $1,000 as a loan and the interest rate on the said loan was 2%, you would have to pay $20 as a fee for that loan. $20 because 2% of $1,000 is $20. Now, it would be fantastic if that interest rate corresponded with reality. Unfortunately, it doesn't. Banks offer you a nominal interest rate on savings compared to what they charge you on loans. Credit cards, for example, charge you an exuberant 22% as an interest rate. Over a year, for a $1,000 loan, you would incur an interest fee of $220. Yikes! In the United Kingdom, the Bank of England is the governing authority on interest rates. The Bank of England will raise or lower the interest rate to help manage and influence the economy and the present inflation rate. What's interesting is the impact rising or declining interest rates have on inflation as a whole. The two are linked. Interest rates will also be raised. When inflation is high, interest rates will also be raised. When inflation is low, interest rates will usually go down. It is important to note that interest rates follow inflation and not the other way around. We use interest rates to manage inflation after the fact. Using it the other way would be market manipulation and gross misuse of power and authority. Low interest rates. When interest rates are low, consumers can take on loans and spend more money. This has a compounding effect on the entire economy. Suppose we think of a farmer on his ranch constantly working day in and day out. One day, the farmer decides to go into the town and visit the bank. His business has been doing well, and the demand for his goods is increasing so much that he cannot meet said needs. The farmer has two choices: raise prices or increase his supply capacity. The farmer asks the banker what the current interest rates are as he wants to take out a loan. The banker explains that interest rates are meager now and would be a great time to expand his business. The farmer takes on the loan, improves his supply capacity, and can lower prices and produce more goods. With his new wealth and business generation, the farmer can employ more workers and spend more money when he visits the town. Because the interest rates were low and the farmer was able to take out a loan to expand his business, the economy of not just the company, but the overall town improved. Low interest rates are good as they incentivize taking loans and spending more money within the economy. High interest rates. Now, let us look at the farmer again. However, this time we will do it in the context of the government implementing high interest rates. Before we move on, it is essential to understand that high interest rates are implemented to combat high inflation. It is better to assume that interest rates are either low or average regularly. However, sometimes they will go too high if the situation calls for it. When we increase rates, this is known as contractionary monetary policy. The banks essentially lower and limit the money supply in the economy. As stated before, this is usually in tandem with high inflation. When we raise the interest rates to a high level, what effectively happens is that the cost of borrowing goes up. This makes it harder to get loans and limits the supply of cash and credit in the economy. The demand for goods and services goes down as people can no longer afford to purchase what they used to. This can be problematic if we look at the farmer who had taken out a loan to expand his business. Let's say the farmer took out a loan of $1 million to purchase land, build a factory, and hire employees. Now, let's also say that the interest rate on this loan is 4%. The farmer is doing well and is more than equipped to pay the interest rate of $40,000 yearly. However, due to a sudden rise in inflation, the government raised the interest rates and the farmer's loans went up to 12%. The total cost of the loan in terms of interest for the farm is now $120,000 a year. The farmer can still pay this but has much less disposable income. The farmer must cut spending to pay off his loans and keep his employees. The town also suffers as the farmer purchased many goods and services to keep things running. Businesses in the city are now also forced to reduce their spending. This will compound throughout the entire town until it affects everyone to a certain degree. What happened here was that the money supply was reduced in the town. Global financial crisis. A great example of interest rates affecting inflation and the overall economy is the 2008 financial crisis. In 2001, after the 9/11 World Trade Center terrorist attack, the U.S. economy went into a minor recession. In response to this, the Federal Reserve streamlined the process of getting a loan and lowered the interest rates drastically. This resulted in a large amount of money being funneled into the most popular asset at the time, property. Because it was so easy to take on a loan and interest rates were so low, citizens across the nation went to banks to achieve what was known as the American dream. The white picket fence, spouse, kids, and a dog. Interest rates were as low as 1%, which meant that citizens were well within the capabilities to afford their mortgage payments plus interest. So much so that some went out and took on multiple mortgages. The rise in the money supply caused a lot of inflation, especially within the property market. What followed was a financial bubble that was ready to pop. Because inflation was so high, the Federal Reserve decided to raise the interest rates to lower the supply of cash and credit and reduce the demand being put onto the property. In response to this, millions of Americans were unable to pay their mortgages and were forced to default. Households that used to pay $5,000 a year in interest payments were suddenly expected to pay upwards of $25,000. It wasn't realistic and forced many people to file for bankruptcy. The property market crashed, and this rippled throughout the nation until it ultimately caused a worldwide financial crisis, all because of a change in the interest rate. It's easy to see how this can happen if we think of a simple analogy. Imagine purchasing a house for $100,000 and paying a yearly interest rate of 2%. You rent out the property and can garner $5,000 per year. This would be a rental yield of 5%. The return on investment outweighs the cost of the loan, so it is a good and profitable venture to get a loan and purchase the house. Let's say the Federal Reserve raises the interest rate to 9%, much like they did in 2008. The loan's cost of the loan outweighs the return from the asset, so you decide to sell. This makes total sense. However, in 2008, everyone agreed to sell simultaneously. The supply of houses now exceeded the demand for places. Homeowners were forced to drop their prices lower and lower, resulting in the price of homes nationwide plummeting. As a homeowner, you have two options: continue losing money on an asset governed by an unstable interest rate, or declare bankruptcy and default on your loan. Many people chose the latter. There was a lot that went on during the 2008 financial crisis and runs so deep that the roots can be traced back to the 80s. But one thing is clear. It all started with interest rates being too low, followed by being too high. The impact these fluctuations had on inflation was genuine, so much so that they were felt the world over. With inflation at a record high since the 80s, the banks lowering the interest rate, and property prices soaring, one can only wonder if we have learned from our mistakes. Conclusion. Interest rates not only affect the economy by influencing stocks, bonds, consumers, and business spending, but they have a genuine impact on the overall inflation and deflation rates. It is the responsibility of the governing authority of a country to manage the interest rates by inflation to keep things at a manageable level. Understanding the relationship between interest rates and inflation will allow you as an investor to understand the big picture and make better investment decisions overall. As a general rule of thumb, when interest rates go up, consumers and businesses tend to spend less, causing inflation to go down. But when interest rates go down, spending and inflation rates go up. The two have an inverse relationship that is constantly yearning for balance. That being said, there is never any guarantee. That is the crux of the financial markets, a force of nature that listens to no one. We hope you walk away from this video with a better understanding of inflation, interest rates, and the relationship between the two. Remember, in times of high or low inflation, we should constantly monitor our spending, prioritize our income, and diversify our investments.